Everybody can hear me. I'd like to apologize in advance. I am fighting a head cold, so if I sound a little muffled and stiffly, you'll know why. So my name is Janice Connors, and I'm Senior Manager in the U.S. and Cross-Border Tax Services group with KPMG. I am out of the St. John's, Newfoundland office. Basically, with respect to the U.S. domestic law, any corporation that is deriving business profits from a U.S. trade or business is subject to tax on those profits. And so, when we're determining whether or not a foreign person is subject to tax on business profits, we usually ask two questions. Excuse me. The first question is the foreign person engaged in a U.S. trade or business? And then also, if they are engaged, what kind of income is effectively connected with that U.S. trade or business? So typically, when we're determining whether or not a foreign person is engaged in the U.S. trade or business, we have to look at the facts and circumstances of what's going on with respect to the activities of that foreign person, and whether or not those profit-oriented activities in the U.S. are regular, are they substantial and continuous? Are they just a one-time type of activity, and so forth. There's really no definition of a threshold for federal tax purposes of what constitutes doing business, and so really it's kind of low. A foreign person may also be engaged in a U.S. trade or business, not just through their own activities, but through the activities of a dependent agent. So that could be, for example, an employee that is going down to the U.S. So once we've determined that a foreign person does have a U.S. trade or business, we need to look at whether that income is effectively connected to that U.S. trade or business. And so typically income is put into two baskets. The first basket would be income that would otherwise be subject to withholding. So your rents, your dividends, interest, that kind of income. And that's what we call FDAP. So that's fixed, determinable, annual, periodic type income. So that type of income is known as withholding income, and it goes into one type of basket. And then all other types of income from the U.S. would go into the basket called effectively connected income. So your sales profits, gains and losses, sale of inventory items, and so forth. Those would go into another basket, which is considered non-FDAP and would be what we call effectively connected income. Now, I won't get into it right now, but there are some cases when you could have that FDAP type income that might be considered effectively connected, such as rents. So it's really important to determine whether or not your income is going to be considered effectively connected to the U.S. or not. Once that determination is made, and we've decided that they have a they have a U.S. trade or business with effectively connected income, that person is going to be subject to tax. And currently, as of January 1st, 2018, with the changes in the tax reform, the federal corporate rate now is 21%. A return is typically required to be filed, and if the person does not file a tax return, or the corporation does not file a tax return, they can lose the ability to take deductions. And what that means is that instead of being taxed on their net taxable income, they're going to be taxed on their gross income. So you have gross receipts to the U.S., you could be taxed on that amount, and instead of on the net taxable income. Of course, there's also some relief provided. So I'm sure a lot of you may be aware of the Canada-U.S. Income Tax Treaty and what that means. So under the treaty, in order for a Canadian business to be taxed in the U.S., it must have a permanent establishment in the U.S. So if the Canadian business is deriving income from the U.S., but does not have a permanent establishment in the U.S. The business will be exempt from taxation with respect to those business profits that aren't linked to the permanent establishment. So basically, what would happen then is a tax return would need to be filed. So what is a permanent establishment? Well, a permanent establishment is not defined in the code. It's not defined in the Income Tax Act. It's defined in the treaties. And so generally a permanent establishment will exist if there is a place of management, a branch, an office, a factory, a workshop, or so forth in a foreign country. Another thing that can also create a permanent establishment that a lot of people aren't aware of is the activities of individuals, such as employees that go down to the U.S. And so even if you just have one employee going down to the U.S., depending on the type of activities they are doing down there, how long they are staying down there, that can create a permanent establishment for the Canadian company. So any business profits that are attributable to the business or to the permanent establishment will be subject to corporate tax in the country. So, for example, in the U.S. But not only that, the individuals that are going down there, and if there's a permanent establishment maintained by the Canadian company, can create tax consequences for the individuals as well. And Don will talk a little bit about that very shortly. So are there any questions right now with respect to the couple of things that I talked about with regards to doing business in the U.S. or permanent establishments? Any clarifications? Yes.
So can you give an example or two of just if an individual does go down, what sort of activities would trigger this? Like, what sort of threshold?
So basically, and I'm not sure if Don will get right into the details of it, but okay, so let's say you have an engineer who's going to go down to the U.S. and perform some services. So whether it's in doing inspections or on a site or something like that, but let's say they go down. If they're going down to the U.S. and they're there for less than 183 days and so forth, and they're just doing the inspection and they come back to Canada, that likely should not create a permanent establishment. What's going to create a permanent establishment is if they're performing those activities and they're there for more than 183 days.
So that's sort of the 183.
The 183 days is kind of a threshold. Now the thing is that, so that could be one individual going down. Now if you have multiple individuals going down at different times, but they're all working on the same project, those days for those individuals would get added together. Now, however, I have had clients say to me, oh, well, I had 2 employees go down, and do I double count their time? And it's no. If they're down on the same days, working on the same project, you wouldn't take 6 days from employee A and 6 days from employee B, and you've got 12 days. If they're on the same days, working on the same project, it's six days.
And the number of employees that the company may have, like the relative size of the company, is not bearing on?
Not really. There are some articles in the treaty that do discuss with respect to businesses that are doing business in the U.S. where, for example, if it was a sole proprietorship or something like that, if you were generating more than 50% of your revenues from the U.S. and spending more than 183 days down there or something like that, you could create a permanent establishment that way. So there's a lot of nuances in the treaties, more so than a lot of times businesses just look at paragraph or Article 5, the permanent establishment article, and they'll look at the first couple of paragraphs, not realizing that there's a lot more to it as well.
Oh, other one that doesn't require us to make a certain number of days is concluding contracts. So if an employee is in the U.S. and they can conclude contracts, negotiate them on your behalf, sign them there, that can create a PE, even if they're not there very often.
So even just signing a contract? Signing
a contract in the U.S., if you have the ability to conclude the contract in the U.S., that can create a permanent establishment. Now there are some nuances around that as well. If it's basically a rubber stamp, So, you know, you were given guidelines by the Canadian head office that, you know, as long as they meet A, B, and C, and you can rubber stamp it, typically that might be okay, because the head office has set up the rules around, you know, what constitutes accepting for a contract. But if you send out an individual, if you've got like CEOs or other individuals down in the US signing contracts in the US and concluding contracts in the US, that can create a permanent establishment.
Just sign it with Canada.
Yeah. That's usually a big one. Yes.
If you have a small business and you're using a consultant that is resident in the U.S. for a portion of the time each year, does that make it a permanent establishment?
There's some exceptions to that rule as well. Usually what you want to make sure is that that person is acting as an independent agent. And so typically, you know, it's arm's length dealings. They're dealing in what they would normally do as a trader business in the U.S. and what they would do for, you know, other customers and stuff like that. So you want to make sure that there's those things are set up so that there's arm's length and that they're acting independent and not considered a dependent agent, and then that shouldn't create an issue.
You mentioned working on the same project, employees working on the same project. Does that matter overall? Is it project-based, or is it?
It is usually project-based with respect for the corporation. So if you've got employees that are working on the same project, but you have different employees working on the same project, and they are down there at different times of the year, you add up all of their time that is spent on that one project, and if it's more than 183 days.
Do you have many different projects?
So each project you'd look at separately. The projects are all,
only if one goes over that 180 days.
then the business profits attributable to that project and that permanent establishment would be taxable. It's not necessarily going to pull in the other businesses. Like I said, a permanent establishment of a Canadian corporation can also create issues for individuals, and I'll pass it on to Don now to talk about who is subject to individual tax in the U.S.
Hey everybody, how you doing? Everybody excited about this? So I'm not sure how much you're aware of what the U.S. does to the individuals, but the U.S. is one of only 2 countries in the world that actually taxes its citizens regardless of where they live. If you're interested, the other country is called Eritrea. It's a little tiny country in Africa, so it's in some really good company. So what happens if you're caught in the U.S. tax net, and that's going to include if you're a U.S. citizen, a U.S. permanent resident, or a green card holder, or considered a U.S. resident by something they have that's called the substantial presence test. And this is where kind of a lot of Canadians that travel down to, you know, they retire, they get their little Florida home, and they go down, and they say, I'm going to go down for 6 months a year. Because they think, oh, it's less than 183 days. Well, the U.S. has a different test for coming up to the 183 days. And it's kind of, they use, I won't go into the actual calculation, but it's based on a 3-year number of days. And basically the rule of thumb is if you're down there more than 4 months in any year, you get caught by this test. And what happens is you then have to file a U.S. tax return to report your worldwide income. And so for us Canadians, if we actually live here and have to file the U.S. return, we're usually okay because the Canadian tax rate is generally higher than the U.S. tax rate. But the U.S. actually has a lot of informational type forms that have to get filed with their returns as well, and their penalties are not at all like they are here in Canada. You know, the rule of thumb is usually any form that you don't file down there is $10,000 per year penalty right off the top. So that gets pretty interesting pretty quickly, gets people's attention. So, basically, in addition to that, if you are not considered a resident of the U.S., so you don't have to file on your worldwide income, but say you are an employee that's going down and working in the U.S., you could have to file a U.S. tax return related to, you know, your employment income that's considered earned in the U.S. There are in the treaty that Janice mentioned, you know, if there's some levels, if you're below a certain threshold, that usually we can get out under the treaty. But there's been some changes under tax reform that have kind of broadened that net as well, like as if the net wasn't already big enough. Because in the US, so if you equate it to Canada, you know, when we file our tax returns, we get a basic personal exemption on our returns. So basically, if you earn less than, say, let's say $11,000, you might not bother filing a return, right? So for people that were going to the US, if their income was below a certain threshold, you would be like, well, you might have to file, but you'll get out of it, so maybe let's not bother. It's not a big risk. They've gotten rid of their personal exemption in the US. And so basically, non-residents now could technically have a filing requirement even if they've earned $1 down in the US. So that's changed the landscape. It changes how we think about things. And basically, we've encouraged people that are going down there or performing services down there as under an employment contract or anything like that to reconsider whether or not they may need to file going forward, because things have changed. Has anybody got any questions on any of that? I'm not sure, like, how many people here today are here for the individual kind of side of things versus the corporate individuals? So we'll keep it a little high level. If you want to talk even personally afterwards, that's fine too. Right?
Just to expand just a little bit, because some people can hear.
Yeah.
Okay. Some people don't really understand. They say, okay, I'm going down to the US and I work for a Canadian company and I'm paid by a Canadian company. My payroll and my earnings are Canadian income. Why do I have to file a US return? Well, the domestic rule is actually that your earnings are sourced to the country where you are performing those services. So although you are being paid by a Canadian employer and you pay taxes in Canada and so forth, if you are performing those services in the US, that income is considered US source income. Now there's a little small threshold and something to get out of it if it's less than $3,000 and you're there for less than 90 days and your company that you work for does not have a U.S. trade or business, then you can get out of it and it would be considered foreign source. In a lot of cases, if your company is deriving income from the U.S., they have a U.S. trade or business, and so you typically wouldn't fall under that exemption. But I think that's where a lot of confusion comes in, is people are like, oh, I'm paid by, my earnings are Canadian and I'm paid by a Canadian employer, and they don't realize that actually the domestic law is that your earnings are considered sourced to where you perform services.
Just one question.
Sure.
You're not going down to perform services per se, but you're going down for your business to meet at meetings and business development. It's just your salary that you're paid here. You still have to?
Yeah, so you basically allocate based on time.
Just
So,
on time.
yeah. So even one day at a trade show could eventually cost
Trade
money.
shows, all that.
Anything that is typically considered part of your employment duties. So even though you're down there, you might not be drumming up, like you're not drumming up sales or anything like that, but you are going to meetings or attending trade shows or conferences, some of that. Anything that is typically considered part of your employment duties would be considered employment services performed in the U.S.
Just a question, even if you fall under the thresholds, so you don't have to pay tax and things, you still have to file a return. They're under the new tax reform.
So if you fall under the 3,000 and you really do qualify for that, you wouldn't have to file anything because your income will be considered foreign source. In prior years, we used to say if you fall under the exemption, which for 2017 was $4,050, we would say, okay, if your earnings sourced to the U.S. were less than that, you wouldn't have to file. Now that exemption is gone, and like Don said, if you have $1, you technically have a tax return. Does that mean you have to pay tax? No, not necessarily, because you may be protected under the treaty. And so the treaty for employees provides 2 outs. The first out is if the income that is earned in the US is $10,000 or less, regardless of who's paying that income, you are exempt from taxation. You should file a tax return and disclose that on the tax return, but there's different places where you disclose it on the non-resident return, but you are exempt from taxation, so that doesn't matter. The other exemption is if you earn income, and let's say you do earn more than $10,000, and a lot of execs and that too, they can go down for a few days and they can earn, like say $100,000. But yeah, okay, there we go. So the other out under the treaty is that if you are in the US for less than 183 days and you are being paid by a foreign corporation, so like a Canadian company that does not have a trade or business, or permanent establishment, I should say, in the US, and provided you're not being paid or by, say, a US employer, then you should be exempt under the treaty, regardless of how much you earn. But you should file a treaty-based tax return to disclose that.
Corporate or personal?
That's personal. Yeah.
Is that based on Canadian dollar or US dollar?
The 10,000 is US dollar, I believe, yeah.
US dollar. And the 183 days is not in a calendar year, it's in a 12-month.
It's in a 12-month rolling period.
So you can't go and say, October to March, and that's your 183.
I've had people fall into it because they, based on, when we went back, and we actually had to go back and go, okay, from January to December, no, from February to like that, and do the 12 months over the 2 years. Yeah.
Any other questions on this? Am I okay to wander, Morgan? Thanks. Okay, so now we're going to move on to some of the themes of tax reform. It's important to know the basis of the tax system, because then you can see how the new government, or Trump, has changed the tax system, the nuances, and it helps to have a basis to work from. So these were the 4 principles of tax reform, what they were hoping to accomplish. It's interesting when we look at the rules and we can kind of reflect on, well, did they accomplish what they said they were trying to? So the first is we have to make the tax code simple, fair, and easy to understand. At one point they promised you'd be able to fill out your tax return on a postcard. So this was just a brief introduction, and I think it's fair to say that they did not accomplish that one, but it was a noble goal. The second was to give American workers a pay raise by allowing them to keep more of their hard-earned paychecks. So it was reducing personal tax so that they kept more of the earnings they had, that they could reinvest it in GDP and purchasing. In that respect, it was interesting. They reshuffled some of the personal tax rates. They removed some exemptions, but they increased some deductions. It was very unusual. There were so many changes to personal tax that I think at the end of the day, we didn't get to that point. Whether some people may be better off, but some people may be worse off. Depends on
where you fell in the tax bracket. If you were taxed at 39.6%, which meant you had to make a lot of money, you probably are better off. But the everyday working man,
So the third one was to make America the jobs magnet of the world by leveling the playing field for U.S. businesses and workers. So that was about increasing expansion in the U.S., increasing people's reinvestment in their business. And there's some to try to get people to do that, and I'll wait to comment on them until we get to those points, but I think they might have done a good job here. And then the bottom was to bring back trillions of dollars that are kept offshore to reinvest in the American economy. So they were really shooting for any U.S. company, U.S. citizens who might have had a foreign company and hasn't brought all that foreign profits back to Canada. So Dawn will touch on that a little later, but the bottom 2 are pretty hard hitting, and you can see that they really went after those really hard. So this is a neat graph to show
one of the biggest changes. So one of the biggest changes was a change in their tax rate. This is just the federal tax rate. You'll see Canada way down at the bottom. The federal tax rate for high rate active income is 15%. Now if you're a Canadian company and you get the small business deduction, you're probably more of a 10% federal rate, but this was for larger companies. But at the very top is the United States, and their top tax rate was 35%. Not all companies paid that because they have a marginal or tax bracket system for corporations, or they used to, kind of like our personal tax rates go up as your income goes up. But big companies paid 35%. When you look at their competitiveness across these countries, they were not competitive at all. So the system's both very technically complex, they penalize people, penalties are huge. At the changes that they made to the tax system, where were the impacts going to be? Where were the costs going to come from? So from an individual perspective, US citizen individuals, they had a net tax cut of $1.1 trillion. So these are big numbers, not ones we normally see in Canada, 1.1 trillion. Businesses, they did a tax cut of $650 billion. And a lot of that is the reduction in the tax rate. But then when you look at the international section, that's where they tried to make up a little of the difference. They said, well, where are we going to raise taxes? How are we going to get our money? It's international, and that's $324 billion. So the net impact of reform was 1.5 trillion. Try to do the math. I don't think it works out perfectly on the slide, but so you'll see they really were focusing on let's make things great for US citizens in the US, let's make things great for businesses, let's try to make up the buffer on international people outside of the US, companies outside of the US, which is bad for us. In Canada, they've just made themselves so much more competitive, and also they're trying to penalize people outside the country. So these are the top 10. We try to look at all the different reform changes and see what are the top 10 biggest hitting in terms of just comprehensive changes that are complicated to understand, or big dollars, things that'll really have an impact on people's bottom lines. So the first is the reduction in the corporate tax rate. So what does that mean for Canadian companies? So because of the permanent establishment concept, if you didn't have a permanent establishment in the US, you would only pay tax in Canada on your Canadian profits. So you could be selling to US companies, have a trade or business in the US, but you didn't have to pay that 35% US tax rate because you didn't have a PE there, or a permanent establishment. 35% tax rate was very unattractive. Nobody wanted to trigger that if they could help it, because you'd rather pay tax in Canada. Because of the reduction in the tax rate, it's a little less disadvantageous to expand at a faster rate. So for example, if your business really wanted to hire an employee to grow your sales in Texas, you might not have wanted to do it before because of that terrible tax rate. But now the thought process could be, well, we'll pay tax in the US, but we'll have more after-tax profits than we had before. We can bring that back to Canada, reinvest it in our Canadian business. You can make decisions about expanding your business that are a little less protectionist to Canada, all with the intent of, your business is going to grow faster, you'll have more money at the end of the day to bring back here and to either pay dividends or buy more equipment, hire more people. So in terms of that's, people there, equipment there, all of that. The second one is expensing of capital assets. So this is really interesting. If you're used to the concept of accounting for capital assets or tax, we take an asset that has a long useful life, like a piece of equipment, and instead of deducting it immediately on your financial statements or on your tax return, we spread that deduction over time to match the useful life of that asset. So something that has a 10-year life, instead of deducting it when we purchase it, we deduct it straight line over 10 years or some other metric, but we spread it out. So in Canada, you get a deduction from tax a little bit at a time. That reduces your tax that you're going to pay, puts more money in your pocket. The US has switched to an immediate expensing of capital assets for the next 5 years. So when you think about it, people buying hundreds of thousands of dollars worth of equipment, and now they can write it off all at once, that's a big reduction in tax, more money available to reinvest. So flip back in your mind to the goals of reform. One of them was to get people to reinvest in the American economy. Well, this certainly does that, because what an incentive to accelerate your investment in equipment. If you were going to buy new equipment now or in 10 years, why wouldn't you do it now and get that full deduction? So for Canadian companies, if they were looking to buy equipment in the US, it's a big incentive to do it now. But if you sell equipment to the US, also a big incentive for people to buy now. So there's good on both sides. Are there questions about those ones before I pass it off for some of the next?
So one of the next big changes that came about with tax reform is with respect to net operating losses. So before tax reform, generally if a company had a net operating loss in a taxable year, the rule was it was carried forward 20 years, carried back for 2. And that rule still applies for net operating losses that were generated prior to January 1st, 2018. After January 1st, 2018, any net operating losses that are now created get an indefinite carryover. Well, gee, that sounds great. Not only that, they will be increased by inflation. Well, that sounds great too. What's the catch? The catch is that those losses now will be limited so that they can only offset up to 80% of your taxable income. So, if you are a calendar year filer and you have a $1 million loss in 2018, and in 2019 you actually have $1 million of taxable income, you will only be able to offset $800,000 of that taxable income. And where they kind of came up with this, you kind of think, well, that's kind of odd. Why would they do that? Well, one of the things that came out of the tax reform for corporations was the repeal of A&T, alternative minimum tax. And the way that A&T always worked was that you had your regular tax calculations based on taxable income, but then on the sidelines you also had this way of calculating alternative minimum tax. Usually it started with regular taxable income, and then you would make adjustments to it for preference items and so forth, and you'd come up. And whichever was the greater tax was the one you paid. Now that being said, if you did happen to pay A&T, you would get a credit for future years to reduce your regular tax. With the repealment, though, and the other thing was that the net operating losses for A&T were limited to 90%. And your A&T tax rate was 20%. So with the repealment of the A&T, you no longer have that limitation. And so what they've basically done is brought that limitation into the regular net operating losses. So like I said, any losses prior to the January 1st, 2018 will continue to be carried forward for 20 years. They will be able to offset all taxable income. There's no limitation on those. It'll only be for the new losses. The next interesting thing that we thought, and just so you know, you can't really tell on this, but we've got some of these bolded. Those are the ones we're going to talk about because those are the ones that we think are probably the bigger items out of the top 10 that came out of the tax reform. But the next one has to do with interest deductibility changes. Basically, before the tax reform, the rule was if you had a loan, let's say from a Canadian parent to a U.S. subsidiary in the U.S., that loan, the interest paid on that loan had to jump over a couple of hurdles. First of all, if there was a test to determine whether or not the debt-to-equity ratio for the U.S. company was greater than 1.5 to 1. If it was greater than that amount, then the interest, if paid, could be subject to limitations in the U.S. And so any related party interest or any interest paid to a third party where the loan was guaranteed by a related party would be subject to this limitation. And the limitation basically was 50% of adjusted taxable income. So you'd start with taxable income, there would be some additions and so forth with respect to depreciation. It's more or less getting to like the cash flow of the company. You get to that, times by 50%. If your interest expense was greater than that amount was not deductible. And so it was carried forward indefinitely until you could actually take that deduction. What the tax reform has done is it's eliminated the debt to equity ratio test. So now it doesn't matter. If your debt to equity ratio is greater or less than, it doesn't matter. It also now applies to all interest, not just related party interest. So that's really opened up for a lot of people whether or not they're going to be able to make these interest deductions. And then thirdly, the limitation now, instead of being 50% of adjusted taxable income, it's now 30%. So they've really lowered down what the threshold is for interest deductibility in the US. With respect to small businesses, and one of the things that did come about in the tax reform with respect to small business, so the definition before tax reform of a small business in the US was a business would average out your gross receipts over 3 years. And if you had $10 million or more in the preceding 3 years, you were no longer considered a small business. They've now expanded that, and the definition of small business now is that if your gross receipts is less than 25 million. So that's, you know, for some of you might be sitting here thinking, wow. To me, that's a big business, but yeah, so they've expanded it, and now if you are, you have gross receipts of 25 million or less, you will be a small business. So the good news is that if you can qualify as a small business, the interest deductibility changes do not impact you. So you are exempt. And there's a couple of other provisions in the tax law that only apply to larger businesses. So small businesses have become exempt from some of those as well. So it's you know, it's pretty good to be a small business in the U.S. That being said, because this was one of the things we were looking at for our clients, I had a group of companies, and they were at $24 million U.S. Just the U.S.-based companies, and we're like, oh my goodness, they might get out of this interest thing. This is going to be great. And then we were like, ding, ding, ding. You have to look at the affiliated group. So we actually had to bring Canada in, their Mexico company, and so forth. And because of that, the affiliated group earnings were greater than 25 million. They could not qualify for the small business. Okay, and so I'll pass it over to Dawn.
So if you think back to Candace's slide where she showed that the individuals and the U.S. corporations were getting the cuts, and then you mentioned that the international spaces where they're doing the pickup, this is your pickup for the most part. As I mentioned, if you're a U.S. citizen and even if you live in Canada, you're taxed on your worldwide income. So let's say you're here, you've lived here your whole life, you've set up a company, you're being very successful, you own this company, and it's a company that's involved in active type of income, right? It's not a services business or anything like that, and it's not like earning passive investment income. So as long as this company was an active type of company, things kind of ticked along very well. In Canada, you would have income on your tax return if you received a dividend, and the same on the U.S. side. And let's say that company's really done well. You've never needed to take out all of the profits that you've made, so you've got some accumulated retained earnings in that company. What they've done is for 2017, and we're going to use retained earnings as a proxy for accumulated earnings and profits. Basically, you have a pickup on your 2017 tax return for all of those accumulated earnings that you've not actually received as a dividend. So think about that for a second, right? So you've done really well, you've accumulated all, your business is taken off, you're doing good, and all of a sudden you have to pay U.S. tax on these accumulated earnings. But you haven't actually distributed them for Canadian purposes, so you're not going to pay any Canadian tax. And now you're going to pay U.S. tax you don't have any Canadian foreign tax credits to use against it, probably, you're in a bit of a pickle here. So this here is when people actually realize what this means, this is a good conversation, or not a good conversation to have, depending on which side of it you're on. But, so that's one of those big pickups. Then that's had a lot of far-reaching effect. I would say our gut feel, and kind of what we talked about around the table when this all came out, is this maybe was a bit of an unintended result for the individuals. I think the reason this came into play was because they were moving to a different type of dividend taxation system for corps, but it caught everybody. So, and then the other thing, just briefly, I talked about a couple things about changes in personal exemptions and standard deductions. Some of the other big changes for individuals are, especially for people living in Canada. In the U.S., you can deduct your property taxes and your mortgage interest and things along that line. The property tax deduction is now only available for U.S. properties. So if you live here in Canada and you've got that big home and you've taken that deduction, that's gone as of 2018. I get a little bit more expensive. Tax preparation fees are no longer deductible. There are investment management expenses. Those have gone away as well. One thing that did change is their estate tax exemption. So in the past, it used to be 5 million grid adjusted for inflation. It's now doubled to 10. Again, Trump's friends will benefit from that more so than the average Joe. But those are some of the big changes on the individual side. Any questions on any of that?
Is there still a graduated tax if you're over the 10 million?
Yes.
So it builds as it goes?
Yeah, so you so for adjusted for 2018, it's 11.2. So there's, not everybody gets into that. Actually, one thing that a lot of people don't realize too is even if you're not a U.S. person, so you're just a Canadian person and you've got accumulated wealth and you're over the exemption amount, if you have U.S. assets that exceed $60,000, you could end up actually owing some U.S. estate tax on your passing, even though you're not a U.S. person at all. So that's an interesting piece of tidbit that a lot of people don't know.
Like in the past, it was, if you were at that $5 million threshold, it seemed like about 500,000 worth of U.S. Holdings was kind of the sweet spot. And went above that, the tax ramped up dramatically.
Yeah.
So is it still kind of that same level of where tax hits the hardest, or is because they've raised it to 10, is the graduation?
So they didn't change the brackets.
They did.
They didn't change.
Okay. So it's still the same. Thank you.
Do you have a question?
Commentary? One thing I wanted to say about the change in corporate tax rate was the goal of that was to get people to reinvest. If companies have more money left over, the hope is that they would reinvest it by buying equipment, getting that nice deduction, hiring more employees, generally just growing the economy. What we've seen before and what I think people are anticipating to see again is companies will send more distributions. They'll pay more dividends. There's always a trade-off between what you expect people to do and what they end up doing. So it may be interesting to see if you're an investor in U.S. companies, what the distribution rate is going to be in the next few years. They expect that there will be more distributions because companies have more money left over. And then from an international competitive perspective, because we're in Canada, we're very concerned about our neighbors south of the border and what they're doing because we're quite closely tied together. Canada was a very attractive spot for, I guess I should statement, a very attractive spot for companies from other countries. It was a nice landing port for international companies who want to invest in North America. They'd come, they'd set up in Canada, and then they'd sell cross-border to the US because we have, though you may disagree when you file your tax returns, a very attractive tax system. We're very friendly, it's very relatively simple, and the tax rates were relatively low for corporations. So with this big change, we're kind of concerned that companies, instead of using us as the launching pad, may direct or invest directly in the US and kind of skip us. So we may have less foreign head offices situated here, which would be less jobs for Canadians. Now, our government is fully aware of this concern and this trend. There just wasn't enough time between when the budget came out for the US in December and when our budget came out in March. So our budget didn't include considerations, what they're going to do to try to make us more competitive, make us more attractive. They've always tried to do that, but they're thinking that they're going to need some aggressive measures, and they're planning to look at that this year, and hopefully by next budget they'll have some plan. Okay, so we wanted to introduce you to our US tax team in Atlantic Canada. So we're the 3 senior managers, and we focus on clients here in personal, corporate, Canadian, and then we have 2 partners who work with us. And then behind us, we have a team of 40 tax professionals in the US Pacific. So the biggest US tax team outside of the US in the world. So we don't always look like that, but yeah, a significant bench strength. We have lots of experience in this, and it's great because our economies are so closely tied together to have that kind of expertise to speak both languages for companies who work in both worlds. So if anyone has any additional questions on anything we covered or anything else, we're happy to field them.
Quick question again on the permanent establishment threshold. So what about just for selling products? Like we sell products into the States where we would buy from a US supplier. We don't actually set foot in the States, but we sell to other US companies from this one supplier. I'm assuming we wouldn't necessarily qualify having a permanent establishment.
No, likely not. And even if the inventory is stored in the US,
we basically we only take ownership, I guess, really when it ships. So we basically just
okay,
distribute
yeah, and you
outside.
can have inventory in the US and not create a permanent establishment from a federal tax perspective. The issue might be states.
That's what I was going to ask next. So then do you still have to register with each individual states that would sell to, like each customer that would be?
It depends on your level of business and what the threshold is for state. It depends on what states you're in. Because
Yeah.
some states do follow the treaty.
Okay.
Now, they might require a tax return. That doesn't necessarily mean you have to pay taxes.
Right.
They may require a tax return. You want to look at the sales tax, whether or not that applies to you.
Yeah, sure, we have to look at each one
Exposure to
individually.
there
basically,
is, yeah. And that's the one big difference between Canada and the US. So in Canada, basically, you deal with the CRA, and then I think with the exception of what, maybe Quebec and Alberta or something like that might be separate, but basically you're dealing with the CRA. The CRA takes care of your tax returns and everything. It's not like that in the US. The states are all different. While they might piggyback off federal tax law, they all have their own statutes and regulations. They all have their own tax laws. They all do their own thing. So it's very much different. And so, yeah, so while your exposure for federal tax purposes is probably low, it's the states you probably need to.
Great. Well, thanks a lot. It's funny, as you were going along, I was talking to a colleague. We were saying it's so lucky that everything has a rule, and each rule has a few exceptions. So it's hard to keep it all straight together. So we are very fortunate to have all 3 of you here today. And I just want to thank again Janice and Dawn and Candace for coming and sharing all of that intel with us. On behalf of Ignite Fredericton and the Fredericton Chamber of Commerce. As a thank you, instead of a gift, we have made a donation in your names to the Fredericton Chamber of Commerce Scholarship Fund to thank you for your information. So thank you very much. And on that note, with the Fredericton Chamber of Commerce Scholarship Fund, for any of you that have children going to university or attending, the applications for the scholarship fund are actually open until tomorrow afternoon at 4 p.m. So please consider applying if that would be of use for your child. and you can find more information at the Fredericton Chamber of Commerce's website. Also wanting to note another informational event that the Chamber of Commerce is running and hosting is the Political Leaders Series, and that was started last Friday, where we had Gerald Burke from KISS NB, who came and provided an update in terms of that party's plans and platform. The Chamber has secured all of the political leaders for each of the New Brunswick's political parties for that series, and tomorrow morning, I believe it starts at 7:30, they'll be having the leader of the People's Alliance Party, Chris Austin, so 7:30 at the Fredericton Convention Center. That will follow, or what will follow with the other leaders. June 1st, they have Blaine Higgs. June 8th, David Kuhn. June 22nd, Jennifer McKenzie. And June 29th, Brian Gallant. So you can also find more information about that Political Leaders Series at the Fredericton Chamber of Commerce's website. I want to thank all of you for coming and attending, and hopefully all of the information shared today has been very useful. I know that our team has learned a lot, so thank you once again for our guest speakers. Thank you for joining. For those who would like to stick around and continue to ask questions individually, I'm sure that the team from KPMG will be willing to stick around. Please, we have lots of food at the back and coffee, so help yourselves, and thank you once again.